A big oil seeing a major sell-off today. ConocoPhillips falling almost 7%. Exxon, Chevron, Marathon Petroleum also feeling the pain. The pullback coming as crude slumped almost 4%. It is now back below $90 a barrel, but it may be a key buying opportunity. Energy analyst Paul Sankey has some ways to trade the space. He's with Sankey Research. He's the top analyst, in fact. I would think that you would be the top analyst at Sankey Research. You say that we have a supply problem here. The companies are not raising production forecasts. So what does this mean?
Well, obviously, it starts with Russia, right? So, I mean, you've obviously got a problem there. If you look at Saudi Arabia, how much they're spending, they're going to get an extra 1 million barrels a day of capacity over the next 5 years. And then I was just at the Phillips 66 analyst meeting this morning, and they say they think global oil demand is going to grow 7 million barrels a day over the next 10 years. So you just obviously got a problem. I mean, it just doesn't add up. At the same time, today's DOE, as you said, had inventory builds. But if you look at the demand side, demand's still very strong. We're still over 20 million barrels a day. And of course, all this is real economy. This has got nothing to do with, some of the more esoteric things that you're talking about. This is real people using real oil, and it's a big deal. The final point I'd make is this week it was reported that the world went past 8 billion in population. So this is real stuff, and supplying that much oil to that many people is a real challenge. And it's, there's nowhere that's growing rapidly apart from Guyana.
And if you think about the base of consumption demand just keeps building, whereas we get cyclicality in some of the demand side of it. My question, I guess, for investors who have seen different parts of the oil trade at different times underperform. Karen and I, we've talked about the oil services. Seems as if drillers are really well positioned now. We're starting to see that international drilling begin. The early folks to the party were really E&P and upstream and folks that improved their balance sheet. Where do you want to be right now?
Well, I was at the Schlumberger analyst meeting, SLB, actually. They changed their name last week, and it was like a rock concert. It was packed as well, interestingly enough. Today, Phillips wasn't so crowded, but they're just talking about a load of free cash flow. So I think in terms of where the market wants to be, we've obviously seen today a big liquidity sell-off, and I think that's just the winners of the year getting pulled back. There's nothing fundamentally wrong with the oil trade here. But as we were saying earlier, some of them are maybe a little bit stretched. For the drillers, and particularly for the offshore drillers, I think that their time will come and people will buy them on the anticipation of this oil problem, almost regardless of multiple. So you see that, for example, SLB trades at 10 times EV to EBITDA, where you've got a Shell or an ENI that I'll talk about, which are trading at more like 3 times. Does that mean they won't go up? I think they will. I think they'll continue to run as this oil run goes on. We're looking for $120 oil by driving season next year. So we're seeing a good run here in oil as we go through winter and into driving season.
All right, so I'm going to ask you for your latest pairs trade. This has become sort of a fun little thing that we do with you all the time, because at one point you made you said an
astute call.
It was short Apple, long ExxonMobil. This is
that was
wild.
the first.
That was the first one, and since then we've asked you every single time, because you said to short Apple at a time when nobody thought Apple should be a short.
It wasn't that. It was nobody thought Exxon should be a long, right?
Well, that too. Two sides of this pair trade. So what's your latest?
We're looking, as we were saying earlier, maybe some of these oils are getting a little bit stretched, with the run that we've had, and maybe after today they're attractive again. It's that tight. But if you look at the comparison to European oils, we've got some, half the valuations or less, as I mentioned. Something like ENI, 2 or 3 times cash flow, Equinor, 2 or 3 times cash flow. These are very, very cheap stocks, and everything looks good for oil and gas. And they've solved a lot of the problems, for example, in the case of ENI regarding Russian gas and alternative supplies, hedging problems. And one of the things we're highlighting is they have a new investor relations who's going to be selling the stock into the US. So ENI is the long. As you know, the whole theme that I've been talking about for the last 3 years has basically been long oil, short NASDAQ. So you can almost kind of choose anything. One of the ones that we shorted at one point was Rivian that we were talking about earlier. Today, because ENI's ticker is E, I just said, well, you can short F, which would be Ford. Both are very, very cheap. But I think the EV and the electric vehicle theme is going to fail quite badly against expectations. I don't think it will fail, but I do think it's going to be a very difficult road for these electric vehicles to be built at a mass scale and sold at a mass scale over the next 5 to 10 years compared to where the stocks are pricing.
All right, Paul. Go be a top analyst at Sankey Research. Thank you for joining us.
CEO, janitor.
Paul Sankey. Grasso, what do you make of this trade?
Yeah, I mean, Paul always has a pretty good pairs trade going on there, so he's been good on that aspect of it. And even he just said that some of these individual names seem a little overextended. ExxonMobil, Chevron seem overextended to me. oil, WTI crude, topped out exactly at the October high, almost down to the penny. I think that the whole space is going to roll over. ExxonMobil looks like it had a blow off top. What follows blow off tops? Craters in price.